Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Wednesday, September 18th, 5:51 p.m. Eastern Time, coming to you from the financial capital of the South, St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Market state, we're in an uptrend. As you can see from the trend gauge over here, we've got the coveted four green arrows, meaning market leaders in bullish slash uptrend, and all five of the major indexes trending above their 21-day short-term moving average, medium-term 50-day moving average, and long-term 200-day moving average. So what happened today? The moment we've all been waiting for, the first rate cut in seemingly forever. Big debate coming into it, and this is the first FOMC meeting in recent memory where there was a question as to whether it would be a 25 point or 50 point basis point cut, because all of the raises, all of the incremental increases in the Fed funds rate, it was clearly, the markets were clear on what they were expecting Powell to do, and he did that. I'm talking about the way the markets were pricing in the chance of the cut and the amount of the cut. It varied a lot looking out, but once you got close to the meeting, it was pretty clear this was the first time that there was a lot of debate. It tilted about 60, about two-thirds to one-third in favor of a 50-point cut, and that's what we got. And then immediately after that, the markets, when that was announced at 2 p.m. Eastern time, the market spiked higher to all-time highs. And then slowly but surely over the next 2 hours, including through the press conference, there was the usual volatility, but it resolved to the downside, a series of lower highs and lower lows into the close, closing near the lows of the day. Now, is this a terrible, no good, awful thing? We don't know for sure. We won't until we see the reaction the rest of the week and next week. But taken in context, the second straight day where we made all-time highs and then reversed. But this is after 6 days of straight up action and then a consolidation day. So very how the markets don't always slingshot to the upside. This would have been a very strong move if it held, very bullish, but it would have been out of the ordinary considering the 6 day move that we had coming into this. So everything with a little bit of grain of salt. But I do want to point out, I saw somebody, I pull this chart out all the time when we want to talk about why we do what we do here at Revere, and that is participate in market uptrends and protect in downtrends. I show these 13 bear markets and how severe they can be, and the percentage gain that you need to get back to even. In this July to October 1990, I haven't confirmed this, but I saw noted from a pretty reliable source that this bear market was kicked off with the market at an all-time high and the Fed cutting rates. Over the next 3 months, it was a pretty rough 3 months, down 20%. But after that, we reversed to the upside and went on a pretty decent run. Didn't have another bear market for 8 years. So will history repeat itself there? We never predict, but if you listen to these videos every night, we take it level by level, interpreting the action of the leading stocks and the indexes, and put money to work accordingly, always with an eye toward risk management. So here are the final numbers: 21 over 21, 8 up, 1 neutral, 12 down, still a positive average of 0.1%. Big eight saw 3 up but 5 down, an average of 0.42%. The RG8, this is our 8 growth ETF composite, was mixed, down an average of 0.05%. We opened slightly positive today. The S&P 500 opened up 0.15%. Went tight, kind of tight sideways into the 2 p.m. Before the big volatility kicked in, and we'll look at that in the charts momentarily, but ended up down by 1/3%. Equal weight S&P down by 0.2. NASDAQ 100 down by 0.4. Equal weight about the same. The Dow down 0.25%. Mid and small caps led most of the day, had huge spikes. after the initial announcement, but gave that all back to finish barely positive. Global diversified 60/40 stock bond down a little less than 1/3%. Same with our flagship GROTECTION portfolio. Let's take a look at the names. And here is the S&P 500 weekly chart dated 9/18/1991. And this is the high off of an FOMC rate cut. And with the market at all-time highs at the point, the S&P at a massive 370. And this is the 20% move down over the next 3 months, bottoming at 294.51 along the way, breaking the moving averages little by little. But when it broke that 200-day moving average, you know how we key in on that. So, and this was really just a failed breakout from this base after a decent run. It uh, tried to go higher for about 5 weeks, rolled over. First it broke the 10-week, then the 20-week, then the 30-week, then the 40-week. And you know that's where we draw the line in the sand. From the high to the low here, nowhere near what the total 20% loss was. So our rules get us out of the way below this black line because this is where all bear markets occur throughout history. And you can see after we um, managed this to survive this, once we got back above the 200-day moving average, we went on a pretty nice run into 1991. So let's come back to present day and take a look at the S&P 500. We'll go to the daily chart, and you can see higher high yesterday before reversing. Higher, I should say, all-time high, breaking above this 5670 top of this range that we've been talking about, and then blasting through it very quickly. Let's take a look at a 5-minute chart today. Boom, right at 230, spiking all the way up in this 5-minute chart, got as high as 5690, and then just lower highs and lower lows into the close, closing near the low of the day. Chart is by no means broken, and you can count 1, 2, 3, 4, 5, 6, 7 higher closes. Yesterday, really a consolidation day. 7 closes before this negative reversal off of all-time highs. So in that context, it looks like a normal reaction, but what is really going to tell the truth is what the market does over the next 2 days. And I'm going to go out of order a little bit here. We think the key to this is going to be the dollar index. The dollar initially spiked lower on the reaction, made a lower low. We've been talking about this for a little while because a weak dollar is a tailwind to the market. And the dollar has been pretty weak since July. But this is the type of formation that looks like it's a possible shakeout. And if it is, look how this corresponds on the 5-minute chart, just the complete opposite of what happened. So after the sell-off, you saw a dump in the dollar and then the dollar rally. This dollar rallying corresponded with not only the S&P coming off, but also the price of bonds coming off, meaning the rate actually spiked. This is the long bond, and also gold initially spiked higher before selling off. So all three going inverse direction to what the dollar did today. We'll be keeping a close eye on the dollar the rest of the week and next week to see if that inverse correlation stays intact. But the zero diversification, if you were diversified between bonds, gold, and stocks today, as they all initially spiked, then all sold off with some relative strength going to mid and small caps. So getting ahead of myself a little bit here. I don't normally show these charts till later, but let's go to the NASDAQ 100 now. Same situation. Made a higher high, not an all-time high, as we've been talking about how these stocks peaked on a relative basis back in the beginning of July with a CPI report. And that is what initially kicked off strength in small and mid caps before they rolled over. So before rallying, just like all stocks have over the last week and a half, 2 weeks, but still above all the key moving averages that we track, the 50, the 21, and the 200-day. The slopes of the lines are not necessarily configured the way we'd like them to be, but today's lows in these moving averages are going to be certainly something to pay attention to, along with, as I mentioned, the dollar possibly being the key to the whole thing. Onto the Dow Jones Industrial Average, same thing, made a higher high and then a negative reversal. S&P 400 mid cap, a higher high and then a negative reversal up near this is four times we've tried to get above this 3120 level on the mid cap 400 before reversing. But again, this is a very strong 5-day move up in this case before this negative reversal. So maybe just too far too fast, but we're going to let the market make that decision for us. Here's the Russell 2000. Again, and this is a key fib Alex pointed out to us in our afternoon call, that it reversed on it. It also corresponds to this 2280-ish level on the Russell 2000. We took our profits in TNA today after this negative reversal. But again, in context, there's nothing wrong with this chart, but you do have to lock some profits in at different instances depending what's going on. And that's what we decided to do today, is take the money and run because on a relative basis, the trade has worked out very well for us, and it's very easy to re-enter once things become more clear as to what the direction of the market is going to be across various time frames. Right now, the trend's still up, just a harsh pullback and a negative reversal after 2 days of making all-time highs at the S&P and 5 to 7 days on the various indexes. Let's go to the VIX. The VIX was up 10% at one time early in the day. No surprise there. Waiting for the announcement and the reaction. Ended up slightly on the day. I've got 3.5% up on the day. And with an 18 handle, we prefer this to be under 16. I showed the dollar. Let's show the precious metals. I did show GLD, but I didn't show the daily chart. So an outside negative reversal against the prior 3 days. Just making an all-time high and reversing. Again, it's healthy. It's still above the 21-day moving average. VDX, we own Nugget. It was up 9% at once before reversing to close down a percent. Massive reversal here in this. Still above the 8-day moving average. Disappointing to see the strength turning, but our stop, which is below the 8 EMA, did not get triggered. Silver, same situation, move higher and then a negative reversal. How about Bitcoin? Still slightly positive on the day, but a negative reversal as well. Let's go to bonds. Here's the broad bond index. You can see it's lower as yields tick up. TLT, negative reversal breaking the 8 EMA when it broke the 8. What we are trying to, I mentioned this several times, we're not going to just diversify into bonds because that's what Wall Street says you should do. We're only going to be in them if we can make a return as strong as or similar to stocks. Situation like back here where you can ride the 8 and the 21 EMA higher. We've been riding the 8 higher with this trade, but it broke the 21. We ended up stopping for a 1% loss. We don't give it all the way down to the 21 and below. The way we handle things like this is if the 21 gets above our cost basis, then we'll give it the 21, but it didn't. So we close that position out for a 1% loss. That's TLT. Let's go to TYX. Here's what I'm talking about. This shows the full chart here. This was yields coming down, meaning prices going higher. Yields actually spiking after this. Again, this could be an undercut and reclaim. The conventional wisdom is this is the long end of the curve. Remember, the Fed can only control the short end of the curve, and maybe it was just too easy of a trade. Everybody thinking, well, if the Fed's hitting rates, everything's going to go lower. And in this case, it undercut yesterday and made a higher high today. That's the 30-year, the 10-year, same situation. That's our inter-asset correlation. Let's go to the tail of the tape. I've covered a lot of the stuff in here. Day count, 1 day down. Height into FOMC, lower lows, lower highs into the close. Not a lot of huge standouts in sectors. A lot of things really spiked up, like banks and gold and home builders, only to come off into the close. By the close, banks and transports ended higher to the downside. It was tech-led, XLK, SOX, and IGV, that's semiconductors and software. Portfolio changes. We sold TNA, took that locked that profit in, and TLT 1% loss, dropping our adjusted beta from 1.28 to 1.15. Um, Keys for tomorrow, that same resistance level overhead now, 56.52 to 56.70. It's been expanded with us making a new high today. So it's actually 56.52 to 56.90. Big band of resistance overhead. And we want to see the follow-up reaction to the Fed and that with the overhead resistance on the S&P. Bottom line on the day, all-time highs again after the FOMC, but then a negative reversal to red. Uh, in contrast to the dollar spiking, and also um, in context, you have to understand, like I said, we've been up 5 to 7 days on the indexes, so normal rest period. But the fact that it corresponds with the rate cut, which is getting a lot of attention, and volatility, got to see what Thursday and Friday bring. All right, let's look at some charts, and we'll go to the leaders of the 21 over 21 and the laggards inside there. So Zillow, a lot of interest rate names benefiting from this uh, projected lower interest rates. And this broke out, continued higher, reversed a little bit, but look at the volume here the last 4 days on this. Zillow seems to like the direction that the Fed is heading in. SEC ADR, this is a Singapore internet, bouncing off the 21-day moving average. DoorDash also breaking back out after a failed breakout of the cup and handle, pulling back, bouncing on the 21. Want to show a sister stock to this, Cart, up near the highs of this really long base. Looks like a massive inverse head and shoulders. Need a little bit of a handle in here, but this has been acting strong with 6 straight up days and holding the gains after the market reversed today. This is not in the 21-21 list, but it's pretty strong. And then let's show Kava, which we own, also closing positive on the day. On the downside out of the 21 over 21, NVIDIA breaking below the 50-21 and 8-day moving averages. This really needs to put in a low today and reclaim them, and see a declining tops trend line here that it needs to get back above. Sprouts down 1.84%, still looks fine above the 8 EMA. Oracle, we own this second day down after a strong move the prior day and a big gap up and reversal the day before that. And Fortinet to the downside, sitting right on the 21-day moving average. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. Our flagship portfolio is named GROTECTION because it is designed with a dual mandate. Jerome Powell talks about his dual mandate. Well, we've got one too. Participate in market uptrends. Market starts to roll over, we get more defensive. Market goes into a downtrend, we get the heck out of the way. Very similar to the way we did in the 2022 bear market. Will history repeat itself against 1990 with an all-time high and then a bear market right off of that, off of the back of a Fed interest rate cut? Only the market can decide that. We'll interpret the action and position ourselves accordingly. And with that, it's going to wrap it for Wednesday, September 18th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.